I got to ask the simple question, or is it a loaded one? Is the Fed done?
Good morning, Yvonne. Good morning, David. What a day, what the past 24 hours have been. And the inflation print has been great news, positive news. Probably the Fed is done, but that's very different to saying that we're going to start seeing easing next year. The Fed has an inflation target. We're still somewhat away from that target. And the easy part of inflation, the supply side of inflation, that has been the easy part, bringing us closer to that target. But wage inflation, the more sticky, the more difficult part, that's going to take a little bit longer to deal with. And the Fed does have that 2% inflation target. We're still some way away from that. So from our perspective, we do think it's going to be higher for longer when it comes to the Fed next year.
Any modest changes to investment strategy because of the data that came out, or have things that basically changed for you compared to the last 24 hours?
I'd say we have been a little bit more constructive on risk assets post the August to October sell-off that we have seen. So we have dialed up a bit of a barbell, sort of more high-quality bonds, treasuries, gilts, alongside equities. We are seeing this Santa rally, but it's also important to remember that if we look at the past couple of years, inflation has actually been great news for earnings. It's been bad news for multiples, but it's been great news for earnings. So as and when inflation rolls over, we also have to remember that some of those dynamics can be impactful for equity markets. So for now, we do think that with seasonality also a very nice tailwind for equity markets, we're going to run with this. But come next year, we're probably more on the cautious end.
Are there specific sectors, George, that come to mind that might feel the headwinds on earnings, to your point, because inflation is slowing?
The sectors that we have been focusing on are things like banks, for instance, banks across debt and across equity. Less so in the US, I'd probably say more so in Europe, or also places like Japan, for instance. Japanese banks is an area that we quite like. Yeah, that's one of the areas that we've been focusing on. And I don't think it's going to be that impactful when it comes to US inflation, but they've got their own dynamics. Fairly cheap on a PB basis. And if we think of Japanese banks, if I think of yield curves, it's very difficult to find a steep yield curve today around the world where there is one, and that's in Japan. And as a result, we think Japanese banks have a lot of upside from here.
George, I want to get more on your bond side of your strategy, right? Because, we've been trying to buy and see how long this sort of bond rally lasts. It seems like, traders are really celebrating this US CPI print now. But what do you think is going to be the driver of bond yields moving forward? Is it the fact that inflation continues to cool? Or 2024, we really have to start factoring in more of the growth concerns, too?
I think bond market, sort of high quality duration, works in most scenarios. Obviously, it doesn't work in a scenario where inflation expectations get de-anchored, and that University of Michigan print was not that encouraging on that front, but outside of that, I think inflation expectations still remain anchored. But that would be the big headwind. Otherwise, if growth slows down, it's good to be a buyer of bonds. If recession narrative picks up, then clearly it's you want to be buying bonds, and with inflation rolling over, again, that's a fantastic place for fixed income and high quality duration assets across the curve.
George, I got to pivot to China, just given all the news that we're seeing, whether it's the geopolitics and the temperatures being lowered. You have our scoop about potential PSL, this so-called helicopter money that could be thrown to aid the housing market. How big of a game changer is it?
So I'll take a step back and say we think that July has been the pivotal moment, the moment where Beijing has turned more pro-growth. And if we think of what have been the big headwinds for the Chinese market and economy for the past many quarters, if not beyond, it has been the property market. It's been concerns around local government financing vehicles on the debt side. And the past few months, we've seen a fiscal stimulus that's gone above that 3%, that's trying to tackle some of the tail risks around LGFVs. So that's one thing that's putting somewhat of a floor on these tail risks, and the other one has been property. Property has been a drag on GDP growth, but we do think that if these rumors do materialize, this PSL money, sort of pseudo-fiscal, again, is not going to propel growth on the property front to the levels that we have seen in previous cycles, but it does help put a floor on the property market. So if these two tail risks are somewhat mitigated and sort of a floor is put below them, then other parts of the market can start sort of driving growth. And let's not forget, growth has actually surprised most investors on the upside this year. And if we look at where that growth has come from, it's not been the old economy. It's been mostly, it's been on the export front, it's been on the consumption front. Consumption has not been strong, but it still has been a key and important driver of GDP growth. And if we think, a year ago, 2 years ago, everyone would be very, very pleased to see those developments take place. Infrastructure and property not being a key growth driver. So I think things are getting incrementally better on that front.
George, very quickly, what's your exposure to China right now, and how do you see that changing?
We have, on the margin, increased exposure on China. The reason for that is PPI. Well, I know CPI has seen a bit of a disinflationary trajectory, but PPI, which tends to lead other parts of inflation, on a sequential basis, it has been improving, and that's good news for industrial profitability in China. And also, everyone talks about seasonality in the US, Q4 being a great time. It's actually good news. Seasonality also works quite nicely for China. And as we see interest rate volatility subside in the US, dollar weaken, treasury yields somewhat sort of come lower, that's actually fantastic news for Chinese equities.